happy Tuesday. I am Kevin Clark. If you don't know, I'm the CEO and the co-founder of Plan Confidence Corporation. We created fintech that takes any unique advice from any financial advisor's firm and creates specific asset allocation models for your clients so they can manage their 401k and 403b plans. And in my daily journey, I ran across Dan Harding, who has some really cool software that kind of dovetails right into that 401k industry, which I thought, hey, this would be cool for my audience to kind of see what he's doing, because he's doing something extremely unique. I have not been a practicing advisor for many years, but when I was, I actually stumbled across a couple of these by accident, and I loved them because they were cash cows and AUM generators for me. They were fantastic. So I wanted Dan to come out and explain exactly what he's done. Dan Harding's the founder of Wealth Prime, also the CEO of Retirement Administration Inc., which I believe is his third-party administration, his TPA platform. He helps financial advisors, CPAs, business owners all across the board use innovative retirement plan and, importantly, tax mitigation strategies to build long-term wealth. So with that, I'm going to introduce Dan, and I forgot, if anybody has any questions at any point in time, please use the questions box because I will be monitoring that, and I will interject whenever we see any type of questions come in, and I'll ask Dan, because I don't believe we have the ability to turn on the microphones or your cameras to do so. But with that, I'm going to stop talking, and Dan's going to take the floor for the next 28 minutes here. So everyone, you can't hear Dan, everyone's applauding you and saying, yay. Welcome, Dan.
Thank you. Well, Kevin, first and foremost, thank you for having me on. I very much appreciate you and the opportunity to speak and kind of move this technology, move these concepts out to a larger group of people. So once again, thanks, Kevin. So hi, everyone. I'm Dan Harding, second generation, third-party administrative and actuarial firm. So my father, Sam Harding, after Vietnam, in 1978, started one of our companies called Retirement Administration Incorporated in downtown Los Altos, so Silicon Valley, back when it was just orchards, honestly. Now it's much larger than an orchard these days. But we pride ourselves on white glove service to our clients. And what we do is we build retirement plan trusts. So a 401k is a type of trust. A defined benefit is a type of trust. So we tailor build these trusts for our clients, and we're able to then, be their administrator or their actuary. So each year they need to file their 5500s. We do that work for them. And and what's called an AFTAP, which is like an actuarial thing. And so each year we help our clients that are in a high net bracket, because most of our clients come in making $500,000 to $2 million. We're in Silicon Valley, so that's that's where the heart of the venture capital is, outside of New York. And so we have a lot of high earners that come to us for tax mitigation strategies. We're lucky enough, we've got 8 billionaires now on our client list, one being Peter Thiel, one being Jay-Z. So we're able to work with our family offices and do lots of exciting things. And the thing about Peter Thiel is he has the largest retirement plan balance in the world. He co-founded PayPal in 2002 with Max Levchin, and then Elon Musk came over later. What happened is the tax rules changed, and Senator Roth put in a Roth provision into the code. That means people could, before they made too much money to do a Roth conversion, and so this kind of separated that, so that it allowed them to have that better taxation. So Peter, who I've never met, by the way, I've only worked with his council of elders, basically in 2004, he converted $500,000 of pre-tax to Roth. So paid the taxes that were due and invested that into 10.8% equity of the Facebook before it was Facebook. That money then got, he IPO'd, and he turned that $500,000 into $2 billion. Since then, he's then invested in a lot of exciting deals like Airbnb, Palantir, SpaceX to be the ones. And so now his account balance is over 13 billion tax free. So we work with that group of people. That's an extreme, right? Like he no one is a better angel investor in the world than Peter Thiel. So we can have the ability in our retirement plans to hold alternative asset classes. So traditional asset classes, and I don't mean to be sophomore, are stocks, bonds, mutual funds, cash, ETFs, and such. Alternative asset classes are crypto. We do a lot of crypto in our plans. We do private stock. We can do life insurance, annuities, so all kinds of unique asset classes that have a different, that have a different kind of type. We have the ability to hold those asset classes inside of our retirement plans. So most TPAs only want to do traditional assets because it's you go to Schwab, it's great. But since we service a lot of these high net worth venture capital clients, we need to have the ability to meet their needs and invest into these alternative asset classes. Now, we don't push assets. We're not in the asset management business. We are in the consulting and actuarial business, very different. So with kind of working in this business forever, it seems like I've been here, I realized that there was a problem. And the problem was that it takes a long time to deliver a retirement plan report because there's no technology that I've seen that is really outstanding and allows people to quickly go from point to point and sell a product and sell a retirement plan. So what I've done is I built out a couple different softwares. This is how you guys see. I used to see my screen, Kevin.
Yep,
okay.
We're good.
Okay, so I'm just going to kind of run through a little high end of the software, and then you guys can see if it would be a fit. Also, I don't charge for my software. I give my software away to friends and people that work with us, so we can then get that retirement plan business. So, and everyone can have their software for free. So we go in, we plug in very basic data. What's your name? Danny. Boom. I am 48 years old. Let's say I make $500,000 a year in this example, and I have 250,000 currently in my retirement plan. I am a business owner. I am single, filing as, and I live in California. So now we have that took 15 seconds or 20 seconds, and it's a lot of very powerful data inside of here now. So we're going to go analyze our tax opportunity. And then it makes all this, make the fax machine noise when it's computing, and now we are at our player card. So here's our profile, right? 500,000, 48. We can change this as well. We can make it on the fly, so it doesn't it just makes it a lot faster, and it calculates instantaneously our effective tax rate, which is more important, I feel, than the marginal. Here we talk about planning versus not planning. On the left, we're making can't speak, sorry, Kevin, over $500,000, and we have zero plan contributions, right? With zero plan contributions, our federal taxable income is about $538K. It's all broken down right here. So the net, you will run $207,000 in taxes if you don't do any planning, versus putting a wealth prime plan together. Same income, but we're taking $220,000 off the top, and which is going to reduce our adjusted gross income, or AGI, down to $335,000, which is going to save us over $100,000 in tax because we have dropped our bracket significantly. And no one likes to pay taxes, sorry. So if we can, convert tax liability into future income and future earnings, then hopefully we're doing our job the right way. All of these buttons are hyperlinked. So there's a definition for everything. So if you have any questions about what the opportunity is, it spells it out for you. It's also about it plays a little bit with the brain because it shows the loss, right? If you don't put a plan in together today, what's the true cost of that down the road? You're missing out on so much tax savings. You're missing out on so much wealth creation that, it helps advisors and CPAs, gives them a much faster way to say, okay, maybe you don't have to do this today, but if you wait 2 years, you're going to lose a lot in tax mitigation strategy, and you're going to lose a lot in wealth creation. So this talks about the decade of delay and how that's not good to do. So part of our business is showing the tax savings. Part of our business is showing the wealth creation. And so this technology, we can get into what the future is going to look like very quickly. So here we have.
Yeah, we got a quick question here.
Yeah.
It said that you showed 220,000 going into a retirement plan. And
Yes.
then the question is, with 220,000 going to a retirement plan, I'm assuming that's more than just a 401k with about 55,000 going into it.
Yep. I mean, so the numbers are as follows. So if you look at 220,000 as a total contribution, that's broken into 3 different buckets. Those buckets are all individual trusts. So we're stacking tax strategies on top of each other. So we have that 401k, 25 profit sharing, which is a corporate company contribution, and a cash balance. So by all of these, when we stack them together, we can get to 220,000, which is a significant way to reduce taxes. So does that make sense, everyone?
And I'm assuming then too, if he was making contributions, let's say he already had a 401k and a profit sharing set up, it would then show, hey, you still could do an additional 175 on top of what you're currently doing. And then that spurs the conversation, hopefully, from any business owner who would ask the next question, how?
Yeah. Right. And cash balance, and not every advisor has heard of cash balance defined benefit plans. They're rapidly growing in popularity, but there's a huge opportunity for advisors because the average contribution into a cash balance plan across the nation is like 200,000 approximately. So, and you're managing the assets to a certain rate of return, or what's called interest crediting rate, which is the plan document of that defined benefit plan. And advisors can usually charge more on that type of investment. So you're not only getting more into the bucket each year, you're able to make that bucket more profitable for you because maybe you're not charging 40 basis points, you're charging 100 on the assets, and that's very common. So it's a great way if you're an advisor, if you're in the tax mitigation or retirement space, it's a great way to have a conversation with a client and quickly show them that you add value because you know what a cash balance plan is. You know who to talk to implement it, and you have a technology that you can pull up on your phone and say, hey, maybe you haven't thought of this. So it enables my advisors.
Yeah, I just want to drive something home that you said too, which if you're an advisor and you're not familiar with the cash balance plan, or maybe you heard about it, one of the things that's extremely unique is this is something that you as the advisor manage. So it's part of your managed platform. That's why Dan's saying, hey, you could probably charge 100 basis points. This is not a defined contribution plan. The employees are not the ones who are deciding what investments to you. You as the advisor are making those decisions, and you're handling that huge chunk of change. And if they have an employee or two or everything, there's going to be more than 175 going in there that you as the advisor get to manage and put it directly under your AUM. So it's not necessarily like a defined contribution plan where your client's going to, get the 30 options to choose from, and whatnot. You have to help them pick that. This is something that you put right under the AUM side of your book, and then you manage based off of what Dan's saying, whatever the target is, 6, 7, 8%, that's what you're trying to earn each year. So it's an incredible way to quickly build up AUM because they do have to put contributions, very large contributions in every year.
Yeah. No, I mean, Kevin, I appreciate you saying that, but it's the easiest way. I'm not saying it's the easy way to make money. Let me retract that. It is, I think, the most, if you're looking to build AUM, having cash balance plans as part of your toolkit, it will allow more high net worth individuals to work with you. So yeah, I think that makes a ton of sense. Let me continue.
And then I'll correct you. Again, it's not the easiest way, like you said, but I think it's a lot easier if you go to somebody and go, "Hey, look, you can put $175,000 in for yourself right now, or you could give $100,000 to Uncle Sam. Which would you prefer?"
Right. Yeah. Choose your own adventure. Right.
And with that, we did get a question in, and let me.
Yeah.
Since he's handling alternative types of investments, is he acting as a custodian also?
We have custodian partners. I do not personally act as a custodian.
So you're not the custodian. You're the TPA, the technology on top of the custodian to make sure we do this part right.
But there's a lot of custodians out there who are in the alt business. I mean, Millennium Trust, Pensco. There's a lot of these groups that actually been rolled up recently that are specialists in being a custodian for those type of assets, and I can introduce anyone to. I know all the sales guys over there, so I can gladly introduce anyone depending on where they want to go.
We've actually had both Alto and Millennium Trust clients invest in Plan Confidence.
What are the odds?
I know for a fact they can do alternative investments.
Yeah, no, they do a great job too. I used to sit on the board at Pensco before they were rolled up, and so I know a lot of people in the space. And if you have questions, then we'll get them answered. So I want to toggle around this board a little bit. So here's what we're doing. We're putting a retirement plan together. We're going to fund it for 5 years. We're going to start at age 48, and we're going to put in $220,000 a year. We start with our asset is at 250. We can always toggle this, and all the numbers change dynamically. So we're putting in for 5 years between 48 and 52, 220K, and then we're going to let it bake. And at 70, or we can change, this to 68 or whatever you want, we're going to start taking our withdrawals out, and we'll be taxed on those withdrawals. And the numbers looks like if I go $380,000 a year, I have 20 years of income runway. Now, most people don't live till they're 90. So you may not need this. Maybe we could then increase the distribution, which would then directly reduce the years that we will have that level funding. So it's a very cool, I think it's cool. I think it's a cool dashboard where we can show different strategies in real time. And, our motto is grow, fund, spend. That's what we're here to do. We're here, level phase 1 is we're going to put our 220,000 in, which is going to save us around 80,000 per year, state and fed. And then we're using a 6% growth on all of our assets. So we're not overshooting the moon on this one. 6 is very reasonable. And so that's phase 1 is we level funding. We've raised it up. Phase 2, we're going to let that money work for our clients. We're going to, from 17 years, from 53 to 69, we're not going to touch it. We're not going to add any more money to it. We're just going to invest it, or you guys are going to invest it. And once again, we have that 6% growth. All these are hyperlinked with definitions and instructions. So it's easy to kind of go through that. And then we have our retirement income phase. So that's, in this example, that's 10 years. Now we can go back up and toggle it to 20. We can do whatever you want. But here's kind of the breakout of the Tron looking like numbers. And we then show that maybe you don't need to plan till 120 on a life insurance policy, or because most people don't live to 120. And then we have just more numbers, more data sets that show the value of these types of investments. And then you guys would have your information on here too, right? So when you put a report together, it has your information, it has our information, and everyone's happy and selling lots of retirement plans. So that's the dog and pony.
We got another question in here. what is the basic price for a cash balance plan and then the annual maintenance costs? So I'm assuming they're talking about your TPA services.
Yeah. So we have a very clear set of skills, and we charge for that. So our 401k profit sharing plans, that's one basic trust. That's going to be $1,500 to set up and $1,500 annually, plus $30 a participant. When we're layering a cash balance plan, it's $3,500 for that cash balance trust for the document, and $3,500 annualized, and then $75 per head. So I brought a client yesterday. It's a one-person plan. They're putting about $300,000 into the cash balance 401k profit sharing combination, and I charge them $5,000 for the two documents, $1,500 and $35,000, and then $5,000 annualized, which is all tax deductible, and there's tax credits associated with these. So the net cost is pretty minimal, but it is. So the answer question, $3,500 a year for the cash balance, which is pretty much in line with the market. There's some that are dirt cheap and you don't get any support, and there's some that are really expensive and they have white glove, and we feel like we have white glove and we're priced appropriately.
And I forgot, I think it was Secure 2.0 or something, created a bunch of tax credits. Do the tax credits for establishing plans apply to a cash balance plan as well too?
Absolutely. So yes, yes, and I can send you, Kevin, so you have all that whole breakdown of what that looks like.
Excellent.
Yeah. Any other? Those are great questions.
Keep the questions coming, people. We got 8 minutes left, so if you got Dan here for 8 minutes, so if you got any questions, feel free to shoot them in there.
Yeah, and if there's, we have another. I'll show you guys another part of the tech. I'll pull it up here. I think I have to stop sharing and then share again. Sorry, 1 second.
And I just went big screen here, and luckily you can't see the spaghetti stain. I used a Tide stick earlier, so that's good.
Are you guys seeing my screen?
Yes.
Okay. Here's this was an earlier version of the product, but it has some additional bells and whistles that the new one doesn't. So in this example, married jointly, 48, let's say I have $1 million in retirement assets. I've got a couple employees at 38 and 35. We push forward, we look at the different setups. And so this uses interesting technology that we built a lot of AI around what people want to do. And so here we have an example of, and I like blocks. I've always liked blocks since I was a kid. In this example, we're looking at $500,000 in income for a client. And if they had blocks of cash, $25,000 each block, they would have 20 blocks. Now, if they do zero tax planning, they're going to be in the red and have to pay 9 out of their 20 blocks to taxes, right? We don't like that. We want to do better. We want to do better. So we say, hey, let's go in, put maybe $200,000 into a cash balance 401k profit sharing plan. Then we're able to build out their unique tax board, we call it. So here's that $500,000 in income. If they do no planning, they lose 9 of their 20 blocks to tax. But in this example, we swooped in and we saved them because we're putting in 200 into the plan, which is going to reduce their adjusted gross income, or AGI, from 5 down to 3, which will drop their brackets from a 45 to a 34. So that's just right there, visualizing. It's the power of tax mitigation is kind of comes all to the front, and you're able to help hopefully bring on some clients. We do have an illustration that goes through life insurance as an asset class inside of plans. We've hooked it up with Pac Life and Penn Mutual to run that, but I'm not going to show that today. I'm going to show you instead a comparative analysis tool between putting 25,000 a year in versus 200,000 a year. We call that the block party. And now we have in real time a comparative look at putting in 25,000, what's your tax bracket? What is everything going to look like? And then we show in real time the math behind it. We're very open with our math. And we show that $25,000 with a 6% growth versus $200,000 with a 6% growth. And what is that going to look like at 71? So if having a net income of 56,000 per year versus 448,000, I prefer this one. And then it's just kind of, there's tools on here that the last thing I'll show you, we have a way to look at, when the clients have signed on, do they want to use Fidelity? Do they want to use Schwab? So we built out a whole interface for them, and they can then quickly build up their investment lineup. And it's, we do a lot of crypto, we do a lot of alts just because we're in the Bay Area. And yeah, it becomes a digitized tool for my advisors to show the value of what they do. And it becomes very powerful because they're able to get a lot more products. They're selling a lot more plans because they're able to do things so quickly.
All right. Speaking of power, we got a few questions, and I have CPAs as center of influences. Can I use this to illustrate how I can help their high net worth clients?
That's why I built it.
Assuming that's what HNW was high net worth clients.
Yeah.
So the answer is yes on that. Question: does this software enable the use of tax deductions regarding for Roth conversions to show the tax savings over the life expectancy?
We haven't built that part of it yet, but that is it's on the board behind me. So
yeah, I don't think it does, but I know there's other software that could easily do that. I think this one is just showing, like you said, the fund, spend, grow, or fund, grow, spend. Hey man, this is how you get people off the fence to start funding stuff. It's your job as an advisor to make them grow it so they can spend it later. And then you could thank Mark for this softball question. How do we get access to his software?
Sure. So I have a new version coming out in a week and a half that I will, Kevin, I will get to you, and then you get to everyone else. And everyone will have the ability to sign up, hold their clients' information in there, and quickly access it and run thousands of reports.
Is the new version of the software free as well?
Yes.
Perfect.
I'm not going to charge anyone on this call, I promise.
Yeah, I know when we first
I do request you use me though as your administrator. Like I'm a loyalty guy, and I want to work with you, and I want to work with your clients. I love what I do.
Explain this well, because when I was an advisor too, I relied heavily on a TPA. We did not have cool software like this, so I had to really paint a picture.
Yeah.
And mostly the picture was painted with Excel spreadsheets, which was not as sexy as what you just created.
I still love Excel though. Okay.
But I would come in with the conceptual stuff, but then I would bring the TPA in to do all the nerd back-end stuff to talk to them and their CPAs and stuff. I'm assuming you do the same. You'll get on a phone call with an advisor or a Zoom or something and help close that.
I'm on Zooms all day long with either showing the software or talking to advisors and CPAs. I do a lot of this with my CPA partners. So I love talking to people. So you guys should all call me.
Yeah, well, Dan, this was amazing. How do they get in touch with you?
Probably should have. I should have had a slide deck.
Yeah, my bad. I should have created that.
But I will send everyone a deck. That kind of what we do. But so my cell phone is 415-205-6500, and I can be reached at dan@wealthprime.com.
Dan@wealthprime.com. Easy enough. Dan, I appreciate your time today. I always like to be very strict with our time because I know advisors have lots to do. So thank you for coming on. If somebody asks too, are we recording this? Yeah, you'll get the recording shortly. Yeah. So thank you all, and stay tuned. Next month, we'll have another guest speaker. But Dan, you did a great job, and I know you're going to be able to help a lot of the advisors close more business out there.
I very much appreciate you, Kevin. Thanks for having me on. Everyone have a great day.
You do. Good night, guys. Peace.